Welcome to The Explainer. I am so excited to jump into today's topic because it perfectly captures just how wildly the modern economy is shifting right now. Today, we're looking at Vistra Corp. Now, if you've been following the energy sector, you probably know Vistra as a pretty traditional utility company, but recently, they've transformed into an absolute high-growth powerhouse. So let's dive right into this and see exactly how a legacy power generator is completely rewriting its own script. I want to hook you immediately with this central question. How on earth does a traditional utility company become a critical player in the AI revolution? It sounds like a paradox, right? We usually think of artificial intelligence as this invisible thing existing up in the cloud, driven by giant tech companies. But that cloud is anchored by physical data centers. And those data centers, they have an absolutely voracious appetite for electricity. This totally unexpected intersection of legacy power generation and cutting-edge AI is exactly where Vistra has positioned itself. And this brilliantly illustrates why major investors are really starting to take notice. In Sterling Capital's first quarter 2026 commentary, they detailed initiating a position in Vistra specifically because of its integrated retail and power generation business model. What you should really take away from this is that Vistra isn't just producing power, they're actually selling it directly to the end users. This integrated model fits perfectly into investment portfolios that are seeking exposure to secular electricity demand growth. They've perfectly set themselves up to capture the upside of our increasingly electrified world. Section 1. Powering the AI boom. The massive surge in data center demand is absolutely the primary catalyst for Vistra's new growth trajectory. And the sheer scale of the partnerships they're securing, it's just incredible. We aren't talking about short-term, month-to-month contracts here. We're talking about landmark 20-year power purchase agreements, or PPAs. Look at this. They agreed to supply 1.2 gigawatts of zero-carbon nuclear energy to Amazon Web Services from their Comanche Peak plant. They also inked a deal for 2.6 gigawatts from Meta across their PJM fleet. And crucially, that Meta partnership helps support 433 megawatts of capital-efficient nuclear capacity upgrades. Why does this matter for anyone tracking the stock? Well, supplying zero-carbon energy to the world's biggest tech companies provides unbelievable long-term earnings visibility. I mean, that is guaranteed demand for decades. Moving on to Section 2, the capital return strategy. $6.3 billion. Just let that number sink in for a second. That is the staggering scale of Vistra's share repurchases, executed from November 2021 through just May of 2026. They aren't just sitting on their cash, right? They are aggressively buying back their own stock. Let's break down the impact of those repurchases, because the math here is simple, but it is incredibly powerful. By buying back $6.3 billion worth of stock, Vistra has retired nearly 30% of its outstanding shares since late 2021. Think of it like a giant pizza. When a company reduces the number of slices by a third, everybody left gets a much bigger piece. This concentrates ownership and directly enhances key metrics like earnings per share and free cash flow. It literally boosts the per share value for every existing investor holding the stock. And get this, they aren't even done. They still have $1.5 billion remaining in their current authorization through 2027. Plus, all of this is supported alongside a historically reliable $300 million annual dividend. So, you might be wondering, how are they paying for all this? Well, the crucial point is that these buybacks are funded by robust free cash flow generation, not by just piling on more debt. They're projecting an adjusted free cash flow before growth of $3.9 to $4.7 billion for 2026 alone. This highlights some serious financial discipline. They're generating so much cash from their day-to-day operations that they can comfortably buy back shares, pay out a dividend, and still have powder dry to invest in growth opportunities. All right, Section 3, Strategic Growth and Expansion. Let's just trace through these recent strategic milestones to really illustrate Vistra's operational discipline. It all starts with the launch of that massive share buyback program back in late 2021. Then, look at what happens in the credit markets. By December 2025, S&P upgraded Vistra to an investment-grade rating of BBB-. In January 2026, they used that strong balance sheet to issue $2.25 billion in senior secured notes. And by May 2026, Fitch actually followed suit with their own upgrade to investment grade. This timeline perfectly shows the undeniable, growing confidence that major credit rating agencies have in Vistra's long-term stability and strategy. And what was that massive January debt issuance actually for? Well, it's to fund the impending acquisition of the 5,500 megawatt Cogentrix natural gas generation portfolio, which they're targeting to close in the second half of 2026. This just proves that they're still aggressively expanding their reliable power generation capabilities to meet all that surging grid demand we talked about earlier.
Section 4, Q1 2026 Earnings and Outlook.
In just the first quarter of 2026 alone, Vistra reported a massive GAAP net income of $1.029 billion. That is a remarkably strong operational start to the year. And you know what makes it even more impressive? Their generation fleet delivered this performance during an extended period of really volatile weather, including Winter Storm Fern, all while the retail side of the business experienced one of the mildest first quarters in Texas history.
Now, if you want a true mic drop moment regarding their profitability, we have to talk about return on equity. ROE basically reflects how effectively a company uses shareholder funds to generate income. The average for the utility industry sits at a pretty slow-moving 11.09%. Vistra's trailing 12-month return on equity? A jaw-dropping 105.64%. Yeah, they are operating in an entirely different stratosphere of capital efficiency compared to their utility peers.
We can really see this play out when we trace the rapid explosion in Vistra's market value over just the last few short years. Back at the end of fiscal year 2021, Vistra's market cap was sitting around $10.5 billion. By the end of 2023, it crept up to $13.5 billion. But then the AI data center narrative, paired with their flawless execution, really took hold. By the end of 2025, the market cap absolutely skyrocketed to over $54 billion, and it's maintained that staggering level right into July 2026. This right here is exactly what value creation looks like in real time. Unsurprisingly, Wall Street is decidedly bullish on this whole trajectory. According to MarketBeat, Scotiabank recently raised its fiscal year 2026 earnings per share estimate for Vistra to $9.14. They kept an outperform rating and slapped an aggressive $298 price target on the stock. I mean, when you combine 20-year contracts from mega-cap tech companies, 30% of the shares retired, and an investment-grade balance sheet, analysts clearly see a massive runway for continued growth here.
Which leaves us with this final, truly provocative question. With AI data center demand continuing to skyrocket, is Vistra's value creation playbook just getting started? They have so perfectly positioned themselves right at the nexus of reliable, legacy power generation and the absolutely limitless energy needs of our future. It's a genuinely fascinating transformation and one that makes Vistra a critical company to watch in the years ahead. Thanks so much for joining me on this explainer, and hey, keep your eyes on the grid.